Today, I'm going to share with you an interesting observation. It's a follow-up to one of the chapters of our handbook of economic cycles that we went through a few months ago. It's the chapter on the Fed. Right, we're going to talk about the solar cycle. What is the solar cycle briefly? And this is from the NASA website. They tell us that the solar cycle is the cycle that the sun's magnetic field goes through approximately every 11 years. You can go into what the actual details are on NASA's site, but what we want to focus on is this periodicity of 11 years, because some of you may remember when we looked at a lot of economic time series from the United States, we found that there was a strong periodicity of 5.5 years. So let's see if there's anything interesting that can be observed about the solar cycle and the US economy. What I will start with here is just a long time series. I think this is from the NOAA website, which shows you the evolution of the solar cycle through time. Currently, we are in solar cycle number 25. What we want to look at is the preceding 7 or 8, and we're going to look at the unemployment rate. So you have the unemployment rate and the solar cycle, but inverted. All right. First thing I want you to have a look at is what happens if we bring up the correlation through time of these series. And this is what we find. See, this rate shading means a positive correlation. This tells us that for the majority of the time, there's been a positive correlation between these two time series, i.e. the unemployment rate and the inverted solar cycle. So inverted number of sunspots observable on the surface of the sun. What is interesting is, you could ask a question. What if we create a bit of a lag on this series? Could you find a better correlation? So for example, if I come through and I start increasing the lag on this and observe the change in the correlation, will we find a figure, right, where we'll get a higher number? Well, here we do, something a little bit better, right? Once again, we're not talking about causation here. We're just making some interesting observations of correlation. If I then look at the history of these two, you find that you get periods of more intense correlation. Of course, this is not something that's observable 100% of the time, but you can see that for most of the history of the unemployment rate, we have a positive correlation between the sunspot cycle inverted with a lag of 72 months. Now, can this help us predict the future? No, not necessarily. No self-respecting person would say that. But I just want to use it for us to qualitatively discuss the past. And the way we're going to go about it is that, first of all, I will introduce a sawtooth function. A sawtooth function that will replace the original series that we had, so no lag. As you can see here, I've just tried to line up the troughs on this inverted series so that I can get rid of the squiggly lines. There we go. I've also introduced a harmonic of that sawtooth function, which just means I've got another sawtooth function at double the frequency. So in each time I have one of those waves of the solar cycle, I've got one that shows 2, which exactly half the period. So as we said, we're now in solar cycle 25. We're going to look through history, going backwards in reverse order, to see how many spikes or how many surges in the unemployment rate did we get within each cycle. Right? I've got a quick summary here. Each star represents when we got a surge in unemployment. So, for example, in solar cycle 21, There were two surges that happened in the first quarter of the solar cycle. Technically speaking, this is not really the classic solar cycle. This is actually with an off step of half a cycle because I have inverted it. But still, I just use this labeling for simplicity's sake. That happened to be what is known as the double dip recession in the 80s. I think it was 1980 and then once again in 1982, 83. Just got some stats on those recessions here in terms of the change in GDP peak to trough, and also the reasons that Wikipedia gives for those recessions. But what I'm interested in more is this timing, right? If we go back to our chart, in the most recent cycle, we had this surge associated with the COVID pandemic, and that happened in the third quarter of the cycle. As you can see, here's the first half, the final. So here is our third quarter. We get that surge in unemployment. If we go to the previous cycle, we had two surges in the unemployment rate. First one with the tech bubble bursting, second with the GFC crisis. That first one happened in the first quarter, second one happened in the third quarter. And the rest are summarized here. So if we're looking at the current cycle, right, looking at the next decade or so, if history were to repeat, we're going to get a surge in unemployment either in the first quarter or here in the third quarter, or perhaps both. That first quarter covers the period basically from now until early 2026. The third quarter is from, let's call it late 2028 to probably late 2031. And what I'd like to do at this stage is bring back our intermarket analysis. And here I've just used historical lags showing a high correlation because I want to project it into the future by combining them all into a composite series. Boom. And what does that show us? For now, I'm just going to hide the sawtooth so that the chart is not so confusing. And here we have it. The period where you'd be expecting a surge in unemployment will probably be sometime from, call it mid-2027, sorry, to late 2028 trough, and then a surge after that, probably into the early 2030s. If I bring back the sawtooth, it's going to get a little bit messy. Yes, there's our third quarter surge if that pattern continues. Last thing I'll bring in is our spectrum analysis from that report I mentioned earlier. I'm going to have to hide a few things once again because it does get a bit messy. This shows those same two expected or potential surges. The first one we discussed into 2026, and then a second right into 2031. If using slightly different algorithms, puts more weight on that second surge. So this just adds a little bit more color to that chapter where we said that a lot of the long-term cycles point to a pretty dark picture for the period post 2027. So looking more at 2028 to 2031 period. Bookmark this. It will be interesting to find out what happens over the next few years. Thank you.